Look, you've been told you have two choices in investing. You can risk losing big in the market, or you can sit on the sidelines and earn nothing. But what if there's a third option? One that lets you limit your losses while still earning upside gains. Let me show you how buffered ETFs are changing the game for all investors here in 2025. Hey, this is Mark Soberman, the founder of NetPicks back in 1996, and I'm really excited to share with you an investment choice that very few people have ever even heard of. All right, I think you'll all agree that lately the stock markets felt like one big roller coaster. What I want to share with you today is a way to step off of that roller coaster and not feel like the image on the right. I know a lot of people have never heard of buffered ETFs, so I want to introduce to you what these are and how you potentially can add these to your trading. So there's a few things you want to understand when it comes to buffered ETFs before I share with you the exact investments. These are defined outcome ETFs. What that means is you will know you can lose will be a percentage, but you also will know the maximum you can make on that will be a fixed percentage. They create a buffer against losses, and the usual time frame is a 12-month period. These are liquid investments, meaning you do not have to stay in them for the full 12 months, but they are built a certain way when they first start. The upside, it can be 15%, 20%, and then it also will cap the downside. And that's where it gets really interesting. You will benefit by completely capping your losses, and it can be substantial. In fact, it can be all your losses. I'll share that with you in a moment. But in exchange, just like any investing, we have to give up some of the potential upside, but only in a big bull market. That's the only time that really comes into play. There are several different styles of buffer ETFs. I want to give you an example. Let's say the S&P 500 dropped 25%, and it's not that unusual for this to happen. If you trade a buffered ETF that has a 10% buffer, you would have only lost in that 25% decline 15%. The first 10%, you don't lose any of it. It only when it goes beyond 10% do you experience a loss. That's a significant difference, don't you think? That's a huge difference overall. Now, there's one company that's really the leader in these buffered ETFs. I'm going to share with you how to find these, and that's Innovator ETFs. They have several different styles. They have buffered ETFs that protect you 9 or 10% of the downside. They have a group of ETFs that protect you 15%, 30%, and even 100% downside protection. Most people I talk to have no idea that these products and options are even available. And by the way, it's not just S&P 500. It could be the QQQ. It could be growth stocks. There's even buffered ETFs on cryptocurrencies such as Bitcoin. These launch on a regular basis. Typically every month, you will see new buffered ETFs launching. You don't have to catch them the month that they launch. You can actually trade one that launched 1 month, 2 months, 3 months ago. But there are nuances you need to look at. For instance, if it's used up all of its downside protection, maybe that's not one you want to add at that time. Or let's say it's gained all it's going to gain on the upside, then of course, those are going to be situations where you're not going to want to go ahead and trade those. But the great thing is you can have this rolling protection on a monthly basis with these 12-month buffered ETFs. So we talked about the recent decline. Last year, we had similar declines. You could trade one of these buffered ETFs where that entire decline got wiped out. In exchange, you're just giving up some of the upside. It's not that you won't benefit from any upside, but maybe the market, maybe you're capping it at 15% and the market goes up 20%, you're only going to make 15%. But in exchange, you had 15% downside throughout that entire year. You may rest a lot easier knowing that. You may be able to protect your investments a lot longer. You'll probably also not panic, which some people do when the market sees a decline. So I want to show you here on the screen some really important stats to understand. The market drops about 15%, 1 to 2 times or more every 5 years. This is not unusual. It drops 20% or more 1 to 2 times every 5 years. So you get these 15% drops, you get these 20% drops. So that means 15 to 20%, it's going to happen not quite once a year, but pretty close. What if you could buffer that throughout that entire 5-year period? You absolutely can. What about 25%? Not as often on the S&P 500. Now, on the NASDAQ, absolutely, it will be more often. But this is just on the S&P 500. Once every 5+ years, you get into that 25% range. 30%, again, doesn't happen a lot, but it can happen about half a dozen times over the last several decades. Since the 1950s, there have been situations where the market has dropped a crazy amount, right? 40 to 50%, complete crashes, depression type of thing. There are ETFs for that as well. I typically would say 15 to 20% because we don't want to cap the upside too much. Markets do tend to be bullish over time, but that 15%, 20% tends to be really in the sweet spot overall. But you just never know when a 2008 is going to happen. You never know when a 2020 is going to happen, right? These things are unpredictable. Stay tuned because at the end of this video, I'm going to share another way where you don't have to cap upside as much, where you can actually generate income on a regular basis, even weekly, and still actually have downside protection. So it almost does what the buffered ETFs do, but I think even takes it one better. Now, who's going to benefit? Of course, if you're near retirement and you're listening to this, can you afford a huge hit to your portfolio the moment you retire? That's one of the hardest things to recover from. You can see why a buffered ETF might be really smart. You can get a lot of the upside, not all, but a lot in a bull market, but have a lot of downside protection. This could be really smart in the right situation. If you're risk averse, if you get really anxious in the markets, this can be a great solution. And if you're just goal-based, right, you're like, you know what? I don't need to maximize the potential upside in the perfect market. If I can get these type of steady returns and not take a big hit on the bottom, this would be perfect for me. That's also where a buffered ETF would come into play. Now, we've already talked about it does cap your upside. It is a defined period. So there are obviously some limitations to it, but you can see overall it's quite powerful. Let me switch over to the website of Innovator ETFs and share with you how you can find these. All right, so if you go to innovatoretfs.com, and I'll put the link in the description down below, they've got this ETF finder. So you just go to the products and you go to define outcome ETFs. That's what we're looking for. And you'll see there's quite a bit more going on here. I even mentioned like Bitcoin, etc. If you have an interest, tell it what you're looking for. You want to click buffer, and then what kind of buffer do you want? There's even 100% buffered ETFs. And these go out longer typically. Like this one goes out to April 2027. And it's designed to protect 100% of the downside. If you looked at these lately, while the market was declining, they were not going down hardly at all. So if I clicked into this one, the symbol is TAPR. You can trade these at any broker. This one started on April 1st, 2025. You can still come in later and trade these. They do have expense ratio, so you are going to give up a little bit. That's the way ETFs work. The cap on the upside, 15%. Now that's not a lot when you think about it over a couple years. You are giving up a fair amount of upside, but you have 100% downside protection. The starting caps on these tend to be lower. That's a very nice potential return, meaning worst thing that happens in 2 years, you lose basically nothing minus expense ratio. And best thing that happens is you make 15+%. That's hard to do in a lot of markets. You can't find that in money markets, dividend stocks, etc. On the downside, you can see this chart here. When that market on the S&P 500 was going down a lot, this was pretty much just buzzing along at break even, and now it's up a little bit. All right, so that's the maximum or the extreme case. Let's look at what you're more likely maybe going to consider, maybe a 15% buffer. And you'll see these will update here. May being the most current month, we have them on the NASDAQ 100, the Russell 2000 small caps, the S&P 500, international markets. That's what I really like about this. You can use some discretion and be invested in the markets that you want to be invested in. But again, if we looked at, for instance, the QQQ, it was the symbol is NMAR. This one started trading in March. We had some declines that started in February. You can see here, this one has a buffer of 15%. So that means the first 15% you are buffered against. And it has an upside cap of 15% as well for that 1 year. You'll notice when the NASDAQ 100 was declining a lot, we were down 18%. This was down a few percent because it is buffering that. You still have a little bit of a loss, but this would get wiped out if we stayed through the entire defined outcome period. And it is designed to cap in the end, at the end of the full year, 15% of that decline. If we were down, for instance, 25% of that time, you would only be down 10%. But we've got that upside cap of 15%. All right, so how do you use this? You may decide, you know what, I want to trade at 15%. I want some downside protection. I'm still worried about the markets, but I want to be able to make money if the market takes off, because how often does it actually take off unexpectedly? And I want to trade the NASDAQ 100, then we would probably start with this one that just traded at the beginning of May. NMAY would be the symbol. You could trade that at any broker. It's from May 1st to April 30th. It has a starting cap of 17% on the upside. So you can make the first 17% of profits on the NASDAQ 100. You'll eliminate 15% of the losses. So you're protected the first 15% over that year. You don't have to buy it on May 1st. It's almost basically where it started. In fact, it probably has a little bit more upside because we're a little bit under the starting price. So if this is appealing, definitely go over to Innovator ETFs and check this out and start to dig in and look at these and what is possible based on what fits your risk levels, what you're looking for on the upside, and what you would like to protect on the downside. Now, as much as I love these buffered ETFs as a potential product to consider for a portfolio, I think there's also some other ways to do it, maybe even better. So what I want to share with you is something I call the ETF Income Accelerator. I wanted a way where I can protect myself on the downside. Nobody can eliminate losses in markets, but what if I could lose less, right? If the market's down 30% and I'm down 10, that's a win. But what if I don't have to cap that upside as much? Maybe I cap it a little bit, but in exchange for a small cap on the upside, I can create regular income on a weekly or monthly basis. We can do that with covered call ETFs. It's another type of ETF, but the real secret, the real key to these type of ETFs is you have to be able to time them because you don't really want to stay in them if the market is in a massive decline. The way that I've done this for myself is I use technical analysis to help me identify when I should be getting into these income generating ETFs. I use the same technical analysis model that I've used for years to help me know when I need to get out and get back to the sidelines. But in the meantime, as long as I'm in these markets, I get paid a distribution every single week or every single month. And I can take that distribution, I can pay bills, go on vacation, invest in other investments, or compound it. Dollar cost average, reinvest in that same ETF and continue to add and grow your position over time. So what I want to do now is I want to invite you to go to the website and the link. I'll put it down in the description below. It's completely free. Put your email in there. I'm going to share the details on the ETF Income Accelerator. We'll be releasing this model again here coming up very soon. If this puts you on a no obligation VIP list, you'll be the first to hear about the release. When you go to that page, put the email in right there, click yes, no obligation. But you jump the line, you go to the front of the line, you get special discounts, you learn a lot more, and can trade this strategy in 5 minutes a week. Think about it this way: potential weekly payouts, downside protection, and using some leverage strategies, the potential to keep pace with the markets. Buffered ETFs are amazing. This may be a way to do it even better. I hope to see you on the VIP list. Go ahead and put in the comments down below if you have any questions about buffered ETFs. If you've traded them before, if this is new to you, I'm more than happy to answer any of your questions on these really unique and innovative products. In the next video that I'm going to share in the channel, I'm going to show you a way that you can generate income on individual stocks such as Tesla, Netflix, Google, and actually get paid this income as frequently as weekly. All right, we'll see you in the next one.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.